everyone, to a live podcast recording of the hit show Fintech Mavericks. I'm Nicole Casperson.
And I'm Drew Glover.
Our guest today is Laurel Taylor, and she isn't someone just talking about fixing student debt. She's actually building the system that would wipe out $1.8 trillion worth of it. She's the founder and CEO of Candidly, which has raised over $60 million to date and partnered with giants like Bank of America, Merrill Lynch, Empower, Lincoln Financial Group, PNC, Schwab, and Vanguard. You see how I got tongue-tied there? And before that, she was running a global business unit at Google. But ultimately, Laurel's mission comes from lived experience. She knows what it's like to lose out on decades of wealth compounding while paying down student loans, not just for herself, but also watching her mom go through it. She's testified on Capitol Hill, influenced legislation such as the CARES Act and Secure 2.0, and has appeared on some of the biggest stages, the World Economic Forum as a technology pioneer, South by Southwest, Milken, and of course, the Fintech FM Summit. Basically, she's one of those leaders who can roll up to the London Stock Exchange for the World Economic Forum one week and then sit down with us to get real about money, mission, and AI's role in the future of financial freedom the next. Laurel Taylor, welcome to Fintech Mavericks.
Thank you. I'm thrilled to be here, Nicole and Drew. What an intro.
Yes. Okay, so I did give a little teaser there. Laurel, welcome back home.
Thank you. I'm so thrilled. It does feel like home. I've had so many amazing conversations from last year's Fintech FM here in San Francisco.
Yeah, and you just came back from the World Economic Forum's roundtable at the London Stock Exchange on AI and financial services, and I've been following Laurel's journey for a really long time, and it's really incredible to see how much she's grown and how much Candidly has grown and just the mission and the traction over the years. I also profiled Laurel's story in my book, Fintech Feminist, so be sure to check that out as well. But you're back from the London Stock Exchange. I know it was like a closed-door, tight-knit group where only 20 founders were invited to such a meeting. What can you share from what happened inside? What can you share with us? On the record.
Yes, on the record. So, it's really interesting. The London Stock Exchange, as a technology company, that was interesting and was new information to me, as I just haven't followed the London Stock Exchange previously. But it was a group of multinationals, a very small roundtable of multinationals, startups, and public sector. And one of the conversations that emerged organically from the discussion, and actually your panelists earlier today were talking about this, which is how do we embed AI? And the conversation was more around embedding AI within our own organizations from an efficiency and velocity perspective, which is the majority of application today. But as a founder and CEO, what occurred to me, and I think the intro there, Nicole, around, we've been around a minute. So I founded Candidly in 2016, and we're the category leading provider crushing debt and building wealth on SaaS. And so we now have a new opportunity to serve through AI and serve the mission of the company and serve end users, employers, and our partners. But what that means as an established category-leading company is re-upping as people, but also re-upping across our investor community. And so keeping some real talk here, I think embedding AI, yes, within our organizations, yes, across our customers, but also it really starts at the board and your investors, because as you build, there is a trough when you're building SaaS. There's a trough when you're building category-leading AI-native product. And so you really need alignment across your board, internally and externally, in that entire value chain for this to actually work.
Yeah.
I feel like there is a huge literacy gap when it comes to incumbent businesses, the businesses that have been around for 50, 60 plus years. All of them, even at the board level, talk about how they want to engage with AI, but there's very little action in terms of them engaging with it. And I think it's very easy for, it looks like the majority of this room, which are all AI first minds, right? We've been building companies during this AI age, but these incumbents, it's a very different conversation. So I'm curious, How has that journey been since you're working with so many of these incumbents and embedding AI into their infrastructure? I'm assuming for some of them, you're probably one of the first true partners when it comes to AI, which is a hard route to take.
The first in anything, always challenging.
It is, and I feel like it is my signature move, for better or worse, which is establishing a new category and then executing with newer technologies. And so, Drew, I mean, you really struck right to the heart of the issue there, which is we are living a tale of two lives, in that we have our established SaaS leading solution, and as you move through enterprise B2B, vendor risk and InfoSec is an incredibly rigorous process that you move through, and your partners are determining which modules of your capability they'll ultimately release into the wild across their very precious customer base and customers of their customers. And so we have product that's SaaS end-to-end, and we have separate product that is AI native, and it will be more difficult over time to keep that very strict compartmentalization. And there are partners who you can't even bring up AI. It's like a third rail, it really cannot even be discussed. And then others that are really leaning in and implementing a person to institutionalize AI across the org, but for highly complex organizations, that is a process in and of itself that may very well be necessary and will bring significant deceleration because of the need to align multiple business units across the organization. So it is difficult for incumbents to get to yes. And I think we'll see those that are much more tech forward and AI forward, and they're talking about this on their earnings call, and they have API libraries, and they're leaning into MCPs, and they know what MCPs are. And then the opposite end of that spectrum are really going to move when they're forced to, and they're forced to when parties like OpenAI bring in applications into that experience where there are, because it's existential. What's your value prop?
And do you feel like the only way they're going to, from a barrier standpoint with some of these incumbents, do you think it's going to be this force function of like the really large players, or do they have very specific barriers like compliance and regulatory rules that they have to follow that's holding them back, or both? I think that it is. I think that we're in the education cycle, one, and I think education is expensive and it takes a long time. And two, the regulatory and compliance stakeholders really need to be in the process from the very beginning, that alignment and that buy-in. Also, candidly, because serving the largest financial services companies in the world is our day job, we built our AI capabilities with a deterministic reasoning engine and in a deterministic manner, so that an end user receiving a guidance from Candidly, or if Candidly is white labeled and they're receiving it from their FI, that the financial institution knows that those are tools and functions and amortization tables, calculations they vetted. They know the model, they've approved the model. We've run it across 2 million simulators, we've run it across a number of environments, and they're extremely comfortable with the precision of the math and the graphs. That deterministic outcome is necessary for the financial services space. And so then you're really isolating, well, what is probabilistic? Well, it's the way that the LLM expresses empathy to the user, which we know LLMs do much better, actually, than humans do. But in terms of the output and the precision, that is incredibly rigorous, can be audited, is observable with decision traces that the regulators will want to see based on results returned to the user and then actions that user took.
Yeah, I mean, you have essentially kind of, in a way, mastered this dance, if you will, that you have to do, right, to be able to get large incumbents, right, across the finish line, to the educational piece, and that us being in that moment right now, I think stands out a lot. And you actually have some news that dropped this week, which, Laurel, you have somehow decided to drop news the same week as my summit. It's like you knew the entrance into my heart. Tell us about what happened this week. What was that?
Yes, so really excited to announce our newest capabilities. So we had previewed our conversational AI tool, which is Kate, and our conversational AI tool is a multimodal interface that is conversational with the user. And yesterday, what we released is our Candidly Intelligence Center. So we released the back-end capabilities. So why am I so excited about back-end capabilities? Because it's a multi-agentic system that ultimately solves problems in service of the user in a holistic manner. And so as you introduced me, Nicole, which again is such a privilege to be here, and I'm such a massive fan of Nicole and Drew, and I'm an outsider. I really relate in many ways to your story. I was outside of saving. I was outside of retirement savings. No one wanted me as a customer early in the day. We were just having a conversation about that. And what we know is that student debt doesn't happen in isolation. Where student debt exists, credit card debt exists. Generally, there's lack of savings. We know through the data that my mom and I missing out on 2 decades of compounding interest on wealth is what 84%, while paying down debt, that's what 84% of users do. And that was from my alma mater at MIT. So knowing that student debt doesn't happen in isolation, a user needs guidance about, well, how do I pay down and manage my student debt in the context of carrying 30% APR on my credit card, the fact I have no emergency savings and my employer offers a match at 6%, which is awesome. If it's someday I thought it were actually possible to forgo that amount, wow, actually they offer the student loan retirement match, so I can just continue to make my payments and now I get a match on my student loan payment. So it's really bringing, I think legacy product is trying to solve problems through static landing pages and funnels built for the masses, where users are showing up in a conversational way in raw unstructured data looking for guidance. And the financial advisory space is missing out on that population. And I think what I've learned in being in this space, I've learned so much. And part of it is that the traditional system thinks that population is uneconomic to serve, with the exception of folks like Chime, who I know you've worked closely with, and others. But the industry at large generally don't want low balance accounts, have legacy technology that is difficult to actually service that population. What's so exciting about the Candidly Intelligence Center and AI is that we can serve the 99% in an economic, profitable way that's great for the user, great for the bottom line, great for growth, and is the population that the industry wants. They just want them 10 to 20 years from now, but we've got to get them into the system, and then they're going to be even more valuable to industry and societally at that point.
Yeah. No.
Yeah, no, I think it's, I love that you're talking about the 99% that are most at risk. You know, most banks, or really all banks, their holy grail is, how do I get to lending? How do I get someone in a checking and savings account, which is frankly a loss leader for any bank? And hopefully 15, 20 years from then, you come to me for a student loan or a home loan, and then that's when they really start monetizing. But luckily, there's been businesses like Chime, there's been these different neobanks that frankly in this market couldn't exist, would not be successful. We don't have the venture appetite anymore to drop $200, $300, $400 million rounds on businesses that are seriously working in the negative. And so I love that your approach is, how do I meet them in this stage of life where I can actually impact and give them the ability, or give the institutions the ability to monetize, which every business needs to make money, and secondarily be able to serve the 99%. One question I do have, and this is just something that I learned when working with Chime and a number of these neobanks, is the loyalty to financial institutions has significantly changed, especially for a lot of the 99%. They have 4, 5, 6, 7 different banks. Like, who knows where they're going to be putting, you know, more infrastructure behind just having a checking or savings account. But how does that relationship with institutions change your business and how your partners engage?
I think that there is it's tremendous pressure to differentiate to your point. So this hypermobility and multiple relationships within service providers. And I think the employer has such an exciting role to play. And we largely serve users today through the employer channel. That was the original vision, which is let's serve at scale through a deflationary CAC rather than an inflationary CAC, because I worked at Google and I realized I would need to raise those 400 million to funds, and that's even more unlikely as a female founder. So let's leverage the ecosystem that already exists, integrate into that ecosystem, and then our primary job to be done, we know we're in user first in everything we do, design and deliver. But ultimately, that's to engage more, that's to deliver more engagement to the parent company and to deliver differentiation to the parent company. So to the parent company, defend your market share, differentiate and grow, and drive dollars through net new AUM. And that's really what we do. We help them defend their market share, differentiate the experience, and ultimately drive net new deposits in AUM because we've operationalized, for example, Secure 2.0. So those employees who are not participating in that retirement match can now get a match on their student loan payments. That's a really special relationship that you have with your employer and then the financial services provider. But do you know, I mean, how many of you know who your 401k provider is in this room? Just raise your hand if you know. Okay. And this is a unusual room in an elite
This is an elite room
right?
that knows, but typically.
And, yeah, but it was maybe like 6, right? And so for this highly educated, super prime population here, so what does that say? Yeah. And so those providers are looking to deepen the relationship because ultimately that provider 401k, they are largely 401k is a loss leader. So they ultimately want to serve across investment opportunities, wealth management opportunities, and that's part of our job to be done is to drive growth for that parent company in a way that is meaningful so that we are prioritized in their things they care about when they wake up in the morning.
Yeah, no, I love this. And when you did leave Google to start Candidly, I always love this story in the book, but you said that often investors would dismiss the mission as philanthropic, and you've already kind of showcased that so clearly that just isn't necessarily what's going on, right? Yes, there's big impact here. There's $1.8 trillion of student debt that is just crushing people, and as you shared, right, student debt is not just your debt, it's everyone's debt, right? Your mom and your grandma and everyone in your family's debt. So I guess I'm curious, like, what kept you from just internalizing those narratives, and how do you think of the definition of a venture-backable business is just changing?
So I'm going to share, because Anna and I were having a conversation, it was really moving to me, which is, real talk. I mean, you just got to keep going. You just have to keep going. Like being a founder, as we know, is relentless, unrelenting. You're just going to get a ton of rejection. And that comes in lots of different forms, not just from from an investor perspective, but there are many businesses I really admire as a philanthropic business. I have, as my Series B lead told me, Anthony Lee of Altos, I have a chip on my shoulder. That is true. Small town Texas, went to Texas State, and then went to my dream school. But I really think it's critical that we prove to the world that margin drives the mission, and that purpose-driven organizations that are disciplined and drive fundamentals of unit economics can build sustainable, scalable companies that tackle the largest societal problems. And I think for me personally, what's so important is I'm very clear that this is my path and purpose. That's very clear to me. This is not easy. It's never been easy. It's not going to be easy. There's like no point of easiness in the journey. No. And I've learned that from folks that are much further down the road from me that are, they have 300 million in ARR and have their own struggles. And so I think when you're signing up, really are signing up to drive the mission moving mountains and markets with our, God-given time and talents that we have. And I just feel like I'm a linebacker every day, just like taking down one thing after the next. And I'm like, yeah, bring it. That's what we're here for.
I mean, when I hear you say that, the first thing the thing I keep hearing as a VC is just like this obsessive focus, right? Like, you obviously have that, but what would you say your most effective unfair advantages as a founder?
Persistence. Persistence and perseverance.
Can you give an example?
Sure. Okay, so I will give an example because there's someone that may be able to help in this room. Being unapologetic and shameless in the ask. So, public-private partnership is really critical. We're at 31% delinquency and default right now in the student debt portfolio. That includes prime and super prime consumers. This is the highest default rate in the history of the portfolio. And because we are a position between the employee, the employer, the payroll system, student loan servicers, treasury, and we facilitate flow of funds, I would love an introduction, if anyone in this room has it, to Frank Bisognano, who was previously the CEO of Fiserv, who's now, just yesterday, been appointed over IRS and Social Security. So right now, the federal government is spending, a cool $1 billion a year on legacy tech that doesn't work, that's delivered 31% delinquency and default. And we can deliver proactive enrollment into student repayment federal programs, number one, to avoid delinquency and default, through payroll data, through Department of Education data, so we're right-sizing real-time programs that user is into. When we have to garnish wages, which Treasury is rolling out, IRS is rolling out, private sector employers are gonna have to garnish wages of employees that are defaulted. That's a letter that's sent, and then the employee picks up the phone to call the default resolution group. Those are things we could have done in the 1980s. We mailed thing in the 1980s, we had phones in the 1980s, and now we can save, $900 million in taxpayer dollars and deliver a humane, dignified experience that also right-sizes again when a frontline worker from Walmart then goes to work for Chipotle. So we don't want to be in this reactive, expensive, shameful experience, which is part of why Candidly is about candid, authentic conversation, where the majority of individuals are beginning their journey in financial services. So the relentless is, good Lord, we've had so many different administrations with different, one administration canceling out the other on how they want to tackle student debt. And we gotta roll with the punches, focus obsessively on what is the way that we can deliver the greatest scale and impact on the mission of the company. And there's no daylight between margin and mission. If we had the opportunity to serve this administration or the next, we are sprinting toward that.
Yes, of course. Your applause will be heard on the podcast, I think. Really well said. Employers who do partner with Candidly do see turnover drop by up to 76%, right? So the benefit clearly being there. What do you see in the future where financial wellness is really just a non-negotiable in these benefit packages and considered true health care? Because we're about to have a wellness hour later today with some incredible brands that are going to teach us more about that, but I think that this is potentially a part of the evolution, but what are you kind of seeing on your end, especially with how much change there is and so much of the regulation that you're having to go flip-flop back and forth with? And is this something people are really caring about on the inside?
Yes, so I think from a financial wellness perspective, we're seeing a lot of focus on financial wellness. Yeah. And then the question is, what's the definition of financial wellness? And when I first started this, back to the perseverance, when I first started Candidly, it really was very novel, the concept, and laughable to some, that this was a problem that needed to be addressed and that the workplace was a natural, intuitive work stream in which to deliver that experience in financial services. Now it's a new category, and we're well on our way to the new normal. And so the new normal and that hockey stick of new normal is really, we're top 2 of 3 requested benefits today, which is requested benefits today, which is table stakes. And I think what's important is that recognition that fiscal and physical health is intertwined and is really one. And we see in the data that, we're talking about healthcare, we're seeing the data that depression is higher, anxiety is higher for those who have student debt. The average monthly student loan payment now is almost $600 a month. We save the average user $358 a month in a few minutes on our platform. So, $4,000 to $5,000 post-tax back in your wallet to be delivered to other essential needs is so important. And so we're just really going to continue on forevermore for 100% market penetration to really help every employer understand that this is a huge issue. It's a huge issue across all ages and wages, and it's efficacious. So that reduction in turnover of 33 to 76%, CFOs love our offering because the ROI is so strong. Employers really want to do the right thing. Many of them are offering 50 different benefits offering, and then not thrilled with engagement. That's really more of a communication and a user experience issue, which the Candidly Intelligence Center addresses, because you show up to solve problems, not necessarily swim between 50 different point solutions. So I think we're well on our way to financial wellness being a norm. I think the bias of the industry is to optimize on the asset side of the balance sheet, and we have to be steadfast that the liability side of the balance sheet must always be part of that equation.
Well, as a fellow Texas girl, your resilience. Did you know that?
I did not. I love that.
I went to Texas Tech.
You did.
We come with a lot of resilience.
Tech. Oh, don't even get. I drove to Texas Tech because I was really excited about Texas Tech. It was a 6-hour drive from my hometown, and I was like, I am still in Texas. 6 hours later, Texas Tech is a great school.
I've made that 6-hour commute many times in my life.
Tumbleweeds, literal tumbleweeds.
There are actual tumbleweeds. I've driven
armadillos too.
Those exist. Yeah, no, they're real. Dust is a normal.
You gotta watch out for them on the highways. I'm serious.
I know.
Armadillos. Flip your
I've
car.
actually driven over a tumbleweed and been like, is something gonna happen to me? They just fly right under your car, guys. Anyways, I don't drive anymore. I live in New York. Okay, sorry. I don't actually know I've ever told you that. In all of our interviews, that was my first time revealing that I'm from Texas.
Kind of shocked by that.
Yeah, most people are. But anyways, we can get into that another time. I love this. So I will say we have just a few minutes left with Laurel. So if anyone does have a question, feel free to raise your hand. Let me know. I will scan the audience and look and see. But yes, so in the meantime, ask it at any time. I'm going to keep going with my questions, though. So with the last few minutes left, let's talk about that founder marathon. You have called being a founder that marathon with intervals. What's the next interval that you're training for with Candidly? I'm guessing it has something to do with the fact that you launched Kate, your AI tool, in July, and now you've launched your Intelligence Center, which is addressing all of these gaps and issues that we've talked about. What else? Or is that the main one?
That's the main one.
How is it going?
So back to focus, which is, as we just urgency. Like as founders, we wake up with this urgency every day of how do we move the needle the most, and what are the levers that we can pull to create the greatest impact to advance the mission, which is to help hardworking Americans go beyond debt into savings and retirement savings. Our point of view on AI is it's really just an enabling technology. It's a transformative enabling technology that's enabling us as a technology company to address the demand we've heard across employers and users and partners, which is how do we break down these silos into a more holistic experience? The front end and the back end of our AI capabilities, as well as our established SaaS solution, forevermore going to be working on the distribution channels that deliver the greatest leverage. One is Workplace. We are working on 2 additional very focused distribution channels, same tech, greater leverage across 2 new strategies, which I'm hoping to share more about soon.
Oh, okay. That was the teaser. That was a teaser. Yes. Hello. All right. The question is building in a category-defining company. How long did it take to kind of build that, I guess, brand up, maybe that credibility, and then also the fundraising, which has been such a joy, I'm sure. I hear it's the best part. I've never fundraised, so anyways.
Yes. So it was not a joyous experience. I was in a rolling close around our seed for 4 years, and the best advice that I received from a serial CEO was, Laurel, try to raise more than you burn in any given week. And so like a $25,000 check, a $50,000 check, a $100,000 check. My first seed investor who came in for $1 million check was, a huge breakthrough. And along the way, new categories, really the burden is on you as a founder to prove the category exists along that pathway. And so I was very deliberate about, okay, first I'm going to go get SMB employers because they can say yes more quickly. And we had no SOC type 1, type 2. I mean, that was not a thing. So we got our first employers. We partnered with a third party to help us move money. Then we won mid-market. Then we won our first enterprise clients. Then we won our first channel because we had evidenced, here's the demand. And look at the demand. It's across 25 employees to over 25,000 employees, and we've proven our ability to perform. It took us about 2 to 3 years to actually move through the flow of funds requirements to stand up our own native ability. And so fundraising, just get started, keep going, evidence proof points along the way, have evangelical clients, solve one problem, do it better than anybody else in the world, and those clients will tell other clients, and they'll get on the phone with your investors who are like, I don't know, tell me about that. What's she like? How does she show up? Can she do this?
Yeah.
What are you concerned about as a customer? And, there you go.
I'll do it. I mean, that Drew once said to me something that I'll never forget, which is your say-to-do ratio is unmatched, right? So
100%. It's got to be 100% every time.
Yeah.
If you do that, especially along the fundraising journey, you will get funded. But keep having conversations with different VCs, different angels, telling them this is my goal, this is what I'm going to do. And if you're able to do that 100% of the time, even 90% of the time, right? Like you're on a really good path because people just start believing in you, especially in those early stages, right? Like I'm investing in Laurel, and then I'm investing in the business. As an early stage investor, pre-seed and seed companies, and this is a true stat, 80% of the time, the product that hits product market fit is not the product that I invested in. It might be a version of it, but typically it's not the company I originally invested in. And so at the end of the day here, you just got to make sure that the person you're investing in is someone that when they're staring down the barrel of a moment where they have to tactically pivot, a moment where the macros are something they can't control, so the business has to move. You talk about like political climates, like there's a million different things. Like I got to just make sure that someone can like chew on glass in the when they're staring down the barrel of a lot of crappy stuff coming their way and be able to move in the right direction.
Alrighty, that does it for this session and this live podcast recording. Thank you so much, Laurel Taylor, for joining us on this episode of Fintech Mavericks. All right.